The information in this document, again, is for general information purposes only. It is not to be construed as providing legal, tax, financial, or professional advice. And we do not assume any responsibility for any reliance on or misuse, especially or omissions, of the information contained in this document. Donations of comparatively small insurance premiums can significantly increase the size of ultimate bequests. It doesn't matter what size the donation is. It's the number of years you pay will impact the premium size commitment, but whether we're talking about someone who wants to buy a small policy and donate it, whether they're old and want to start doing this strategy, whether they're young and want to do this strategy, there's still a considerable spread between that premium commitment and the ultimate size of the benefit. Or put it another way, the donation made directly to a charity versus doing it in this particular manner. One challenge, of course, that we have is that most charities are in need of cash donations now and generally focus on discretionary donations today instead of building foundations for the future. And when we're looking at life insurance, of course, we're looking at building a foundation for the future. Donors are keen on strategies that optimize tax assistance and relief via reductions in income tax at the time of donation. And that may be while they are alive or as part of a legacy. So how can advisors help clients with deciding on the best course of action, particularly when dealing with high net worth clients? Today's session will explore a new and creative way to double up on donations and maximize the use of life insurance to multiply the gifts donors are interested in making. And it will close with answers to immediate financing arrangements generally and a case study comparison on the collateral insurance deduction. When we're looking at leveraging assets for charity, the primary objectives voiced by people who are interested in charitable giving include the following four things: the ability to preserve net income, to reduce investment risk, to preserve estate capital, and to guarantee charitable bequests. Few people, as I said earlier, can afford to make substantial contributions out of their current income, the kind of donation that would equate to the sum insured of a life insurance policy. So donations of comparatively small insurance premiums can significantly increase the size of the ultimate bequest. There is better assurance that a bequest will not be contested if the charity is named directly as beneficiary on the policy versus an intent to make a donation via will or a beneficiary on a will that could be challenged a little bit later on. From a charity's perspective, having that charity as the owner is better assurance still, particularly if the policy is paid up or will be paid up quickly. People, donors, are keen on strategies that optimize tax assistance and relief via reductions in income taxes at the time of donation. And sometimes they want to be able to do two things. They want to make a donation and they want to get some benefit other than the deduction or the tax credit for that donation. They want to get some type of benefit from, in this particular situation, the life insurance policy. So that brings us to this whole matter of split receipting. And as we know, split receipting is permitted. You can name multiple charities as beneficiaries or owners if gifted on an ownership basis, and that's okay. That was decided to be okay by the Canada Revenue Agency as far back as 1998. The premium and the policy values would be apportioned between the donor and the charity. And again, it's okay on a case-by-case review, again, according to several Canada Revenue Agency information technical bulletins. And this whole issue of acknowledging split dollar gifting appears to fit within the spirit of proposed legislation on split receipting. And that was confirmed at the Conference of Advanced Life Underwriters 2003 roundtable. So again, we're going back quite a bit of time here. So when we're looking at leveraging life insurance, we can create two bequests with one donation. So in the first scenario, I'm looking at the Thompsons, and you've seen this scenario before. They're great believers in charity. They also want to leave a legacy to children and grandchildren. So they're torn. Do I leave something to the charity? Do I leave something to my children or grandchildren? How can I do both? And if I start splitting everything up, can I actually make and leave a sizable legacy to either party? The legacy to charity and or their children or grandchildren would be received by them as a last bequest on the second passing of the Thompsons. So it's important to note that in this scenario, which is a very common scenario, whatever things they want to leave behind to children or grandchildren or to their charities is something that would happen as a final bequest, as a testamentary legacy for them. Their question, and the question that gets asked by a lot of people in similar situations to theirs, is how can they do both? How could they, in fact, leave something to a charity and leave something to their grandchildren, especially if they have limited dollars available and they want to create a meaningful legacy to both parties? Now, while looking at their initial donation, with that initial donation directly made to a charity, they can set up a joint last to die insurance policy, a legacy that's created for the charity of their choice. They would go on with annual donations to the charity. The charity would, in fact, own the policy. Depending on their province of residence, federal and provincial tax credits can amount to as much as 50% or more of the donation. These tax credits would then provide the necessary cash or cash flow to allow the Thompsons to invest those funds into a second joint last to die insurance policy. And that second policy will provide a tax-free bequest for the children and or grandchildren. Now, this unique strategy creates a multiplying lasting legacy that benefits the charity of their choice and their loved ones, and does it with that simple, same initial outlay, in this example, of $10,000. The example that you're seeing on the screen right now is based on a 69-year-old male non-smoker and a 67-year-old female non-smoker who have a single equivalent age of 59. In this example, we're using joint last to die estate max, a permanent participating life insurance policy, payable to age 100 with a base plan with enhanced dividend option, and that reduces that premium commitment for the sum insured. The example, of course, I'm sharing with you is for demonstration purposes only. Actual tax rates and credits will vary by taxable income and province or territory of residence. Premiums that you're seeing, of course, here for estate max are based on the premium rates as of 2020 for the life insured indicated. The amounts may be more or less than those shown depending on the life insured's insurance age, their smoker status, their health, the initial coverage amount, the dividend option, and the payment period. But the graph you're looking at, in this basic example of the Thompsons wanting to do two things with that same outlay of $10,000, comes right out of a graphic of one of our brochures that talks about charitable giving that you can find on our website. So let's look at a different kind of leveraging. Meet Clarence, who's 50 years of age. He owns and operates a successful programming business. He's been approached by a charity he's long supported. And Clarence has been asked to join a group of others in a foundation pledge. The commitment, $50,000. Not a one-time commitment, $50,000 for 10 years. Naturally, he can donate directly to the charity. But what about his heirs, should he wish to leave them something? Because he's looking at donating that entire $50,000. He doesn't want to commit more than $50,000 a year to either the charity or funding a legacy for his heirs. He wants to see, what can I get for $50,000? And what about the flexibility of payments? Now, Clarence has fared better than most over the years, and though impacted by the COVID-19 pandemic, his business has stayed afloat. He would, however, like to look at options, even though he foresees absolutely no problem in maintaining his commitment to helping build that charitable foundation. He has been shown how life insurance may be used to leverage his donations and monies set aside for legacies. He recognizes that he can get more bang for his buck if he uses life insurance to create a legacy for children or grandchildren. But he asks the age-old question, should he structure the plan so that he can get a tax receipt for the premium, or should he structure that same plan and get a tax receipt for the much larger sum insured when he passes away? Number one or number two? A final legacy is what a lot of people end up doing. Clarence has taken pretty good care of himself, and he expects to live a long time. The thing is, the charity needs money sooner than that. So when looking at a charitable legacy builder, consider the following two things. The life insurance policy can be owned by the charity, who is also the beneficiary. Here, the premiums would generate a tax receipt. Or number two, the life insurance policy can be owned by Clarence personally, with the charity as beneficiary. The sum insured would generate a tax receipt on his passing. Now, there are pros and cons to each approach. When a charitable legacy builder is owned by the charity, who's also the beneficiary, generally there's no legacy for the family, and that may or may not be an issue. There certainly is a loss of flexibility controlled by the owner. The charity prefers a limited pay structure so that they don't have long-term concerns about funding the policy. When a charitable legacy builder is owned by the individual with the charity as beneficiary, that structure optimizes flexibility for the individual. The potential donor can apportion the sum insured amongst a number of charities. He could split the benefit between a charity and children, and the donor can change their mind about who gets what. Heirs, family, and courts may contest a beneficiary designation, particularly if it shows up in the will, and the charity is less secure with that second scenario. So again, pros and cons to each approach. Now, in this particular case study, remember that Clarence is comfortable with the concept of leverage. He's used leverage a number of times. He's comfortable with borrowing. He's used lines of credits on an ongoing basis to build his business, to expand his business. He's been doing it for decades to build his business, and even for investing outside of his business. But what he wants to know is what $50,000 for each of 10 years can actually buy. He speaks with an advisor who has been working with the charitable sector, who tells Clarence that this could purchase around $700,000 of life coverage. The advisor proposes 3 product options. 1, and by the way, these are all permanent participating life insurance policies, so the coverage is permanent. 1 is a 10-pay plan, a guaranteed 10-pay plan. 1 is a guaranteed 20-pay plan plus additional deposit options to take it down to 10 years. And the third one is a life pay plan plus additional deposit option to take it down again to 10 years. So in all situations, he's looking at about a $50,000 commitment for 10 years. The advisor also introduces Clarence to the leveraged charitable giving strategy. Specifically, the advisor explains how a charitable immediate financing arrangement may work to address the age-old question about whether to focus on getting a tax receipt for the premiums paid each year or for the sum insured at death. The advisor decides to show Clarence how he can supercharge his donation to accomplish both of these things, to have his cake and eat it too, to get a credit for the donation today and get a credit on his passing. Clarence, because he's comfortable with leverage, decides that he wants to borrow the full premium each year. And he decides to capitalize the interest charged by pledging additional collateral because he doesn't want additional out-of-pocket costs in any one year. So again, how does immediate financing arrangements work? And how does this all apply? Clarence applies and puts a life insurance policy into force. He goes to a bank familiar with immediate financing. When his loan is approved, the policy is assigned to the lending institution as collateral to secure a line of credit. Clarence borrows up to the annual premium by providing additional collateral security. He's quite comfortable doing that, and his financial situation offers him a lot of breathing space to do it. Clarence pays the recurring policy premiums, and though he understands that he may pay loan interest monthly or annually, he decides to capitalize the interest payments and therefore not have any more out-of-pocket expenses. Again, this way, he has no other out-of-pocket expenses, just as if he was donating the money directly to the charity. Clarence then uses the line of credit for charitable donations. Now, there's some other things that an advisor needs to point out to the client about loan conditions, which will be covered off later in today's presentation. Clarence then does the following. He donates the borrowed cash each year, equal to the premiums he is paying on the life insurance policy and equal to the commitment he made to the charity. He gets no deduction for the interest charged on the line of credit, but he gets a tax receipt equal to the premium deposits on the charitable legacy builder. Clarence names a charity as the beneficiary of the policy. The charity gets the residual amount of the policy after the loan repayment on Clarence's death. His estate gets an additional tax receipt for the sum insured donated to the charity. And should Clarence wish to leave something for his children or grandchildren, he can name them as partial beneficiaries of the policy and make those changes anytime during his lifetime. And this particular structure avoids any issues with split receipting and deemed donor benefits from an income tax perspective. Now, when we compare these two scenarios, and let me go back a slide for a second and just emphasize one thing. When we look at Clarence's situation, Clarence now is in a situation where he gets a tax receipt for the premiums and a tax receipt for the net sum insured. Now, that wasn't true with the Thompsons because the Thompsons were using the tax receipt to fund the second policy. So when we compare these two approaches, the Thompsons to Clarence's approach, both multiply the gifts to the charity using life insurance. The Thompsons use the tax credit to replenish the estate benefit for grandchildren. Clarence doesn't use the tax credit to replenish his estate benefit. He simply gets extra cash flow from paying lower income taxes, as if he had simply made a donation directly to the charity. What's more, Clarence can multiply the gift to the charity during his lifetime and at death. He also has alternatives, as mentioned previously. He can have the net sum insured pass on to heirs instead of the charity, or he can split the net proceeds between the charity and his heirs. Now, there's a lot of words on this page, but this is the typical words that you need to keep in mind, you need to be mindful of when we're looking at actual illustrations and strategies. And there are going to be some variabilities in here. So what I wanted to do, I wanted to share with you today, not only is how this thing works on an optimal basis, but what would happen under adverse circumstances. So I'm going to show you a stress test of this strategy under a current dividend scale or a primary dividend scale and under an alternate dividend scenario, assuming an alternate dividend scale that applies to a reduction of 1 or 2%. In today's example, I'm going to show you 1% interest rate factor reduction to determine what would actually happen. And the two scenarios then are used to demonstrate how fluctuations in dividend performance can impact the overall performance of the plan or the strategy. And again, as you have to keep in mind, actual results may be more or less favorable than those illustrated. Now, one of these things, of course, will involve getting a bank loan or a line of credit. A bank loan is offered by a charter bank. You need to contact a bank with experience in immediate financing arrangements for details about bank loans for this concept. The annualized loan rate that I'm using in this illustration is 5% throughout the illustration purposes only, and of course, it is not guaranteed. Now, I'm going to go through a summary of the comparisons of those three product structures that the advisor proposes to Clarence. Again, each one involves a 10-year premium and deposit commitment. In the first example, we're looking at that guaranteed 10-pay plan, the annual base plan premium commitment for 10 years. And this shows you 10, 20, 30, 40, 50 years out, what the net benefit will be to the charity after the loan is repaid. Right? So Clarence takes his policy, he assigns it to the bank, he takes the entire premium, money equal to the premium, he donates that to the charity, he capitalizes the interest by pledging some additional collateral, and for all is said and done under the primary dividend assumptions here, this is the net death benefit that would be payable to the charity, or perhaps payable to his heirs, or split between the two, if you're to die after 10, 20, 30, 40, or 50 years. Here's what would happen if you took a 20-pay plan and did exactly the same thing. And here's what would happen if he actually bought a life plan with additional deposits, but did it down for 10 years. Now, as you can see, when I'm looking through these comparisons, the highest annual base premium commitment is the Optimax Wealth 10-pay plan. The lowest is the life pay plan, which of course has the higher additional deposit options. So that's one way of comparing these three options. This shows which product has the highest net death benefit available to the charity after the loan repayment on the death of the policyholder or life insured after 10, 20, 30, 40, or 50 years. What you can see in this example right now is that the life plan with additional deposit options kicks up the highest net death benefit to the charity after the loan repayment for at least the first 20 years. But sometime between years 20 and 30, the 10-pay plan actually takes over and now pays a higher net death benefit from there on through to age 100. The 20-pay plan with additional deposits has results between those two. So it never really beats the other two at any point in time. Now let's compare the lowest figures by corresponding category here, okay? So what I'm looking at here is that whether we're looking at a 10-pay plan, I'm looking at a 20-pay plan with additional deposits, or a life pay plan with additional deposits, the deposit stream is $50,000 a year. The pledge you're making to the charity is $50,000 a year. What we're borrowing from the bank is $50,000 a year. So the total lifetime donations, whether we use this strategy or whether we used or didn't use this strategy, as far as the charity is concerned, they're getting $500,000. It doesn't matter to them, but it may matter to Clarence. And that's why we're looking to the total charitable donations with immediate financing during lifetime and at passing. And this may, of course, pique the interest of the charity as well. What we're seeing here is that the lowest total donations that the charity could get, the lowest ultimate combined benefits the charity could get from lifetime donations and that terminal estate benefit or legacy, charitable legacy, comes with the 10-pay plan after 10 years at $948,000. Between years 20 and 30, the 20-pay plan with additional deposits kicks up the lowest total charitable donation, so lifetime donations plus that terminal donation. The highest that you'll get, occurring for the first 20 or so years, will come with the life pay plan with additional deposits. But if Clarence lives to life expectancy, he's a healthy individual, at year 30, he'd be 80 years old. Clearly, the 10-pay plan would provide the best benefit, not a lot more than the life pay plan, but somewhat more, but clearly after that period of time. And again, what you got to take into account is that life expectancy measures the point in time that half the population passes away, the other half will live longer. Once you stretch it out to 30 years, past 30 years, the 10-pay plan will kick out a higher total benefit to the charity, because that's what I'm showing right now. Or if we were to subtract the net death benefit here, which I'll show in the earlier slides or have shown on the earlier slides, would kick up the highest net benefit that could perhaps go on to heirs instead. So again, the life pay option performs best in the first 20 or so years, then the 10-pay plan moves to the top. Now, these three slides compares and stress tested the same three products in a current -1% dividend scale. So again, if we're looking at the annual base premium commitment, the highest premium commitment, of course, is the 10-pay plan at $41,476. The lowest one, of course, is the life pay plan at $25,000. If we, however, were to now compare the net death benefit to the charity after the loan repayment, again, after 30 years and onwards, the 10-pay plan will kick out the highest net death benefit to the charity after the loan repayment. When you stress test plans, it's okay to show something that doesn't work. I think that shows the integrity of our illustrations, the integrity of our product, the integrity of what it is we're about to share. And what I'm sharing with you in this particular situation is that if you opted for the life pay plan with additional deposits based on a primary dividend scale, but then you stress tested it at a dividend scale -1%, what you'd find out is the net death benefit to the charity after the loan repayment would be 0 in year 38. The pledge policy would no longer be sufficient to actually cover off the outstanding loan. So there is no net death benefit. In fact, there may be an ongoing commitment to put up additional collateral to pay for this. If we're looking at the highest and lowest values on death, again, in terms of premium cash flow required, 10-pay is the highest. And of course, life pay is the lowest. If we're looking at the net death benefit to the charity after the loan repayment, clearly over the longer term, And again, between 30 and 40 years, but from 40 years on, the 10-pay plan is viable. It is viable, even under a dividend scale minus 1%. The 20-pay with additional deposits at least is viable. It doesn't perform as well, but it is viable throughout lifetime. The 10-pay plan with additional deposits is no longer viable once we get to year 38, which, by the way, is around or just after life expectancy for Clarence. So that may or may not be a concern, but I think it's notable to understand that here's what happens on a current dividend scale minus 1. Again, if we name the charity as the beneficiary of the net proceeds, here's the bottom line comparison. The total lifetime donations, whether we use financing or whether we donated it straight to the charity and didn't even buy an insurance policy, no matter which option we pick, even under a current dividend scale minus 1, is the same. As you can see, columns 2, columns 4, column 6 are all $500,000. It doesn't matter. But the total charitable donations that you can get with immediate financing does change. So with immediate financing, the numbers change completely. In the first 10 years, the 10-pay plan has the lowest benefit. But you may argue that's also where the lowest risk is as well, of Clarence actually passing away. Over the longer term, what we're seeing is even at a current dividend scale minus 1, we've got a viable plan, still a very healthy amount of charitable donations with immediate financing. $845,000 would be the total charitables. That's $500,000 of lifetime donations plus an additional $345,000 of death benefit. So you're really adding in year 40 that $500,000 plus a net death benefit, bring it to $831,000. At age 50, still almost $800,000 in total lifetime and terminal donations. You still end up on the plus side with 20-pay, with additional deposits taking it out of 10 years. But what we're seeing right now is the total lifetime and terminal donations that the charity would get if you did a life play with additional deposits is $500,000. The charity is never going to get any more than $500,000. Now, they didn't ask for any more either, but they're not going to get any more no matter what happens. And in fact, there is nothing left after year 38, zero. But you've been capitalizing the interest payments, so additional collateral will continue to be necessary in order for the bank not to call the loan while Clarence is still alive. So let me look at those additional collateral requirements. We did that work for you. On a current dividend scale, the time required to have to pledge some additional collaterals is about 21 years. That would extend to 37 years if it was a current dividend scale minus 1. The highest amount in a given year would be $146,000. Under a current scale, it jumps to $167,000, almost $168,000 on a 10-play. And how long would that happen? When would that happen? With that highest amount, year 10 in both scenarios. If we're looking at a 20-pay plan right now, the time required to pledge additional collateral is 28 years. It's essentially for life. If you're looking at a current dividend scale minus 1%, the highest amount in a given year would be $156,000. So not a lot more than in the 10-pay plan, but some more. However, once we go to the current dividend scale minus 1, it jumps to $215,000, and that happens in year 20. If we go to the light play plan with additional deposits, on our current dividend scale, the time required that you'd have to pledge some additional collateral would be 30 years. The highest amount, $122,000. So it actually requires the least amount of additional collateral. However, it requires collateral for the longest period of time. The highest year, year 10. So on a 10-year basis, if you're to compare the 10-pay plan to the light play plan, you'll notice that the highest amount that you might have to pledge in a given year, the advantage falls to the light play plan with additional deposits at $122,000. But keep in mind, the obligation extends for a further 9 years, 30 years instead of 21 years. Once you stress test this entire strategy with a dividend scale minus 1%, the time required to pledge additional collateral is 50 years. The highest amount in a given year, $466,000, and that happens in year 49. So now you're pledging additional collateral that's now approaching the initial amount you decided to borrow. So that really doesn't make sense from this perspective, as well as the perspective of the fact that the life insurance would be completely used up by year 38 if you die at that point in time. You're pledging additional collateral to make this thing work. So you've donated $500,000, and you're going to have to come up with an additional $500,000 to make this thing work. So that's a commitment you probably don't want to have. So what's most important to you? And this is a question you need to ask your clients. If you're looking for the highest early testamentary bequest, then pick Optimax Wealth Life Pay with additional deposit options. If you're looking at the highest ultimate testamentary gift, so if someone could live a long, long time, the Optimax Wealth 10-pay plan will kick up the highest numbers. Note, of course, that Optimax Wealth Life Pay with additional deposits is not sustainable under lower dividend scale assumptions. If you're looking for the lowest annual premium commitment and the maximum payment flexibility, then the Optimax Wealth Life Pay with additional deposit option gives you that opportunity. Again, what's most important to you as the client, you as the donor? If you're looking at the highest potential lifetime donations amount, well, it's the same for all scenarios. Whether I used any of these product options or whether I donated directly to charity and didn't even buy the life insurance, the lifetime donation amount to the charity is exactly the same. You do, however, need to pledge additional collateral in any of these scenarios. But that allows you the opportunity to multiply the gifts to the charity, which is the scenario where I've got right here, or to have an opportunity to leave a legacy to heirs or other people. If you're looking at the lowest long-term demands for additional collateral, then the Optimax Wealth 10-pay gives you that. And of course, if you're looking at deductibility of collateral insurance coverage, it's a question that comes up. Remember, this isn't even applicable. We're not concerned with deductibility of collateral insurance because instead of deducting the cost of the insurance, we're actually deducting the cost of the insurance or a portion of the insurance relative to the borrowing, essentially the net cost of pure insurance. We're deducting the actual premiums in each and every case, which is a much bigger number. So that brings us really to the second part of the section here, which is a more conservative approach. And then this more conservative approach, we're looking at leveraging the policy only, no additional collateral pledge. And in this scenario, let's look at Reggie and Eloise, age 50, who run a successful real estate business. And they've been approached by a charity to, again, to join a group of others in a foundation pledge. That's what they want to do. And they want to make a 10-year commitment. That's what they want to do. So again, they're asking the question, what about flexibility in payments? That may or may not be a concern down the road. They, again, could donate directly. But again, now they're saying, well, what if I want to leave something to heirs? What if I want to leave something extra to a charity? What could I do? Again, in this situation here, the couple is comfortable with leverage and borrowing, particularly Reggie, and he's a very healthy individual. So they're asking the same question that Clarence did. What can $50,000 for 10 years do? Well, in this scenario, about the same as the other one. Permanent participating Optimax Wealth, 10-pay plan, about $700,000 of sum insured. They could either a 10-pay plan, a 20-pay plan with additional deposits, or a life pay plan plus additional deposits. But a little more conservative approach means the following. The couple is comfortable with leveraging and borrowing, particularly Reggie. He's quite healthy. Again, they've been introduced to leveraging. They're very familiar with leverage. They've used it to expand their business a few times over the years. The couple has been shown how life insurance may be used to leverage donations and monies set aside for legacies in a seminar that was co-sponsored by a charity and the financial advisor. Reggie and Eloise recognize that they too can get more bang for the buck if they use life insurance to create a legacy for children and charity or just a charity. But they got some of the same questions that Clarence has regarding when do I trigger that tax receipt? When do I get those tax credits? Do I do it now or can I get it later? And they want to take a deeper look at how a life insurance policy owned by them personally and with the charity named as beneficiary will perform under different scenarios. Specifically, they want to borrow the full cash value each year. They don't want additional out-of-pocket costs, so they opt to capitalize the interest. They prefer to limit their leveraging to a collateral assignment of the policy only. Again here, let's look at that $50,000 deposit for each of 10 years. This is what happens with a 10-pay plan. Here's what happens with a 20-pay plan with additional deposits. And again, I'm showing you how long they're paying the additional plan, how long they're paying for it. 20-pay plan, additional deposits. Again, the annual base premium commitment is 20 years. Additional deposits can take that down to 10. It's not guaranteed, it can. And that shows you the net death benefit of the charity after the loan repayment under the current dividend scale. And the third option, of course, is the life pay plan with additional deposits, again, down to 10 years. The annual base premium commitment is life, but we're hoping that with those additional deposit options on our current dividend scale, that 10 years will be the total commitment. This again shows you the minimum cash flow required. What happens here in the various scenarios. It, of course, is the same whether we're looking at borrowing up to the full cash value or the full premium. That annual base premium commitment is going to be identical. The net benefit to the charity after the loan repayment are different here. Why? Because the borrowing amount from the policy is lower over time. So that's going to kick out a much higher terminal benefit. So the couple here gets lower tax credits today, but the death benefit at the other end is much larger in all scenarios. If again, we're looking at the net benefit of the charity with additional collateral, this was the former example, you looked at $448,000. If we're looking at 10-year plan or the 10-play with net death benefit of the charity without additional collateral in the 10-pay plan, it's $583,000. So I'm showing you here what happens pledging or not pledging additional collateral, just to show you what the difference would be. Again, here, the lowest net death benefit is the 10-pay plan after 10 years. The highest, and it's almost twice as much, is the net benefit of the charity without additional collateral if you took a life pay with additional deposits. But again, that advantage drains out just after 20 years. The advantage then goes to the 10-pay plan from there on in. $920,000 after year 30, jumping to $1.6 million net benefit to the charity without additional collateral. If we're looking at the total donations with immediate financing, then the total donations with or without financing, again, $376,514. I added that up under the 10-pay plan. The total charitable donations with immediate financing would boost that even after 10 years to $959,000. But 30 years down, where you see all the green numbers, clearly the 10-pay plan performs the best. It jumps it to almost $2 million total donations, lifetime and terminal, of almost $2 million at age 100. The 20-pay plan, again, $369,000 in total lifetime donations, whether or not they used immediate financing. So what we're assuming is if you're donating the cash value, so donate the cash value or donate equivalent to the cash value each and every year. So there's your total, $369,000. It kicks out, of course, a much higher death benefit in the first 10 years, but then it fails to surpass either one of the two examples on either side after that period of time. If we're looking at the total net lifetime donations with or without immediate financing, the highest number you can get in the first 10 years, biggest tax credit you'll get in the first 10 years, comes with having the life pay with additional deposits, almost $400,000. $394,854. And it kicks out the highest total charitable donations as well if you use immediate financing, $1.2 million after year 20. So a slight edge over the $1.1 million with the 10-pay plan. But after that, it falls behind. And clearly the advantage falls to the 10-pay plan. And in fact, the lowest total charitable donations you'll get with immediate financing is the life pay plan with additional deposits, which kicks out, as you see, in the red on the last column. So if I'm looking at the highest or lowest minimum cash flow required, the highest, lowest minimum cash flow required, of course, is the life pay with the initial deposits, gives you the most amount of flexibility, but you're trading something off for that, and that is the net death benefit of the charity or heirs after the loan repayment. This, of course, shows you the dividend scale -1. What's different here is you're only borrowing up to the cash value. So even at a dividend scale -1, that is still a viable plan, but it doesn't give you the highest death benefit. In fact, the 20-pay plan at age 50 years down the road is almost 4 times that at least. Clearly, the lowest net death benefit to the charity after the loan repayment is the 10-pay plan after the first 10 years. But once you get out to life expectancy, it takes over and is a clear winner. Year 30, year 40, year 50, a clear winner is column number 3 here, the net death benefit to the charity after the loan repayment. Again, the comparisons show that for the same premium and deposit commitment, the net death benefit to the charity after the loan repayment is higher when only the equivalent to the full cash value is borrowed from a bank for the first 10 years. So you're kicking out higher death benefits down the road. Less tax credits now, higher death benefits down the road. Again, if you're looking at the highest and lowest values on death, here's the other comparison here. Again, he needed to share this with you because if you look at Clarence's situation on a dividend scale -1, what would happen? Let's just flip over to the life pay with additional deposits, the last 2 columns. Of course, it goes to 0 in age 38. What I'm saying is that if you're pledging additional collateral, it's not even viable because additional collateral at some point in time is going to approach what that original loan amount was going to be, or the original donation stream is going to be with $500,000. But if you're only pledging the cash value with no additional collateral, it still is viable, even at a dividend scale -1. So at year 30, almost $500,000, $487,459. Year 40, over $300,000, even at age 50. If not age 50, but year 50 or age 100 here, at a current dividend scale -1, there still would be a net death benefit to the charity, no additional collateral, of $120,000. But again, the other 2 options, both of the 2 options would kick out a much higher number. Again, if you're naming the charity as the beneficiary of the net proceeds, and you're looking at the total charitable donations with immediate financing, a 10-pay plan, doing it or not doing it, in other words, additional collateral, no additional collateral. Clearly, again, if you're looking at columns 3, 5, and 7, so the total charitable donations with immediate financing, clearly, you're going to get a bigger bang for your buck, ultimately, because you're using life insurance here to provide that testamentary benefit, and you're going to get an additional tax credit as well. So in none of these situations are we actually using the tax credit for any other reason than to simply reduce the net cash flow commitment of the client, to free up cash, to reduce the tax brackets, to give the Reggie and Eloise, to give Clarence more net cash flow, less commitment here. Clearly, the advantage goes to the 10-pay plan, year 30 and on. But for the first 20 years or so, the total charitable donations with immediate financing, 1.4 million against, and then 1 million even in 20 years. If you look at total lifetime donations, whether if you didn't use any financing, it's only $352,000. So 20 years down the road, on the life pay with additional deposits, 20 years down the road, if you never took up this strategy, what the charity could expect to get is $352,000. What would they get on passing? Nothing. What could you leave your heirs at that point in time? Nothing. If you actually engaged in the strategy, donated the same amount of money to the charity, which is just the cash value of the policy, then what happens that the charity would still get the $352,000 all the way through. But on passing, if Reggie and Eloise passed 20 years down the road, there'd be $1 million, almost another $600,000 in death benefits going out there. That drops to $839,000 in year 30, $657,000 in year 40, and $472,000 in 376. So a lot of numbers here, and one thing to always keep in mind, because there's a lot to digest here, reach out to us, reach out to your account executives. We can get you a handout of these materials so you can explore them at your leisure, and hopefully this will get the conversation going about this particular strategy and where this actually fits. Again, what's most important to you when you're borrowing up to the cash value? Well, if you look at the highest potential early testamentary bequest, clearly Optimax Wealth Life Pay with additional deposit options. If you're looking at the highest potential long-term and ultimate testamentary gift, as well as the potential long-term and ultimate tax credits, it's Optimax Wealth 10-Pay. If you're looking at the lowest annual premium commitment and maximum payment flexibility, the Life Pay option gives you that opportunity. If you're looking at the highest potential lifetime donation amount, again, the current dividend scale, Optimax Wealth Light Pay with additional deposit options. At the dividend scale, minus 1%. Again, Optimax Wealth Light Pay with additional deposit has a very slight edge over Optimax Wealth Pay. So very slight advantage, not a lot, but it does. But again, in that situation, there's no need to pledge additional collateral. So if you're looking at optimizing leveraged charitable giving, if you want to borrow up to the full premium deposits, first off, you've got to be able and willing to pledge additional collateral. You've got to be able to do that. Secondly, your donations are going to match the premiums and deposit streams. So whether you did this or didn't do this, the charity is going to get exactly the same amount of money. You're matching the direct donations if you're not using that strategy. You're getting higher tax credits now, and you're getting lower estate benefits later. That's what's happening. When you're borrowing up to the full cash value only, you're either unable or unwilling to pledge additional collateral. That's fine. You don't want to pledge additional capital. Your donations match the full cash value. It doesn't match the deposit stream. Your donations will vary year by year, and it's going to be less than the direct donations, but that may be okay. You'll get lower tax credits now, but you'll get a much higher estate benefit later and much higher tax credits at the other end of the line. And that concludes my section of the today's presentation. I will now pass it on to Radis Popovich, who will talk a little bit more about some of the background you need to understand about immediate financing arrangements, and then we'll go on to the collateral insurance deduction and show you a case study about how this works with additional deposit options. Thank you for listening in.
Thank you. Now I'll be reviewing some more basics of the immediate financing arrangement and a few things you and your prospective clients need to know to make an informed decision. I will then switch gears and spend some time on a more common scenario we run into in support, collateral insurance needs, and the collateral insurance deduction. To start, although immediate financing arrangements can be done personally or corporately, most of the discussion will focus on corporate IFAs. IFAs allow individuals or business owners to purchase the life insurance coverage they need without foregoing business or investment opportunities. So with an IFA strategy, a life insurance policy is purchased and then assigned as collateral to a lending institution. The borrowed funds are then used for business or investment purposes. Interest is typically serviced monthly or annually, and the full loan repayment does not occur until death. Death benefit proceeds are used to first repay the loan and second as tax-free payouts to beneficiaries. The strategy can also create tax efficiencies with collateral insurance deductions, loan interest deductibility, and the capital dividend account credit. Often, the CDA credit created by the life insurance policy will exceed the net death benefit, that is, the life insurance proceeds minus the outstanding loan balance. This excess CDA credit over and above the net death benefit proceeds can enable a corporation to remove other trapped surplus as tax-free capital dividends. For an IFA strategy, we want to be sure to use not only the right product, but also the right product structure. The right product structure, customized to suit the client needs, can help or hinder an IFA sale. Should we maximize long-term estate values or early cash values? Should we use guaranteed payment structures or offsets? The good news is Empire Life's participating life insurance product shelf does offer maximum flexibility with guaranteed payment durations as well as additional deposit options that can suit a client with any need. Most lenders prefer to lend against participating policies because of the guaranteed premiums, coverage amounts, and cash values. In fact, some lenders will lend up to 100% of the policy cash surrender value for par policies. As you know, Empire Life does have two options with participating products. Optimax Wealth, which focuses on high early cash values, and Estate Max, which looks to maximize long-term or estate values. Because of the high early cash values, Optimax Wealth seems to be the most common choice when it comes to immediate financing arrangements. This, of course, minimizes the need for additional collateral when wanting to borrow the full amount of premium. Within the product itself, we can choose from various payment durations, such as 8-pay, 10-pay, 20-pay, or life-pay. With IFAs, we often see an 8-pay or 10-pay structure due to client and lender preferences. The recent enhancement to Empire's participating products was the additional deposit option, or ADO. This will enable clients to make additional deposits over and above policy premiums that are immediately used to purchase paid-up additions. This enables immediate cash value and death benefit growth. If selecting a 10-pay, the additional deposit option can be used to maximize early cash values within the guaranteed 10-pay payment structure. If using the life pay, the ADO can be used to not only provide the maximum early CSV possible, but also enable the client to take advantage of collateral insurance deductions long-term. To summarize, with an 8 or 10-pay, the client is not concerned with long-term tax deductions. for example, an older client or a business owner who may sell their business. And with a life pay, it can be a more tax-efficient method as collateral insurance deductions are optimized long-term and early cash values can be maximized with additional deposit options to improve premium flexibility. Now, moving on from the product to identifying potential IFA clients. The typical IFA client would be a high-earning business owner or professional 35 to 65 years of age. I say high earner as this would imply a high tax rate, which would increase the internal rate of return of the strategy. This could be anyone from a farmer to a doctor to a senior executive. Now, an advisor would typically recommend the IFA to these clients for one of the following reasons. One, the client is looking to invest the money that they would use for the life insurance policy into something like real estate, the stock market, or other investments. Or two, the client is looking to reinvest the money they would use for the life insurance back into the business. Whether they may need to update the business or would simply like to expand, the funds required for the life insurance premiums are needed elsewhere. And of course, the IFA strategy allows these clients to purchase the life insurance coverage they need without foregoing this investment or business opportunity. Some more reasons where an advisor may recommend an IFA include clients looking to increase the internal rate of return on an estate planning strategy. Essentially, if an advisor were to recommend a permanent participating life insurance policy, but the client is not satisfied when looking at the long-term internal rate of return, the advisor can recommend an IFA strategy as a way to overcome this objection, as the internal rate of return on estate values can be higher when using the strategy versus when not using the strategy. Also, clients looking to increase the size of the CDA credit. Of course, this implies we are dealing with incorporated clients with significant retained earnings that can take advantage of a CDA credit. And then we have the clients with existing power plans. So not only can the existing power plans be used for the strategy, but there also lies an opportunity to use the cash surrender value of the existing power plans as additional collateral required for a new policy and strategy. And lastly, there's the personal borrowing, and this refers to corporate clients looking to immediately borrow against policy cash values, personally outside of the corporation. The basic strategy assumes the client and borrower has sufficient income to pay premiums and additional deposits, sufficient income to pay for loan charges, and is qualified to write off interest and collateral premium deduction for income tax purposes. Now, some caveats on collateral loans. So firstly, if the loan amount exceeds the assets pledged, that is the cash surrender value of the policy and potentially additional collateral pledged, then the lender may demand more collateral to maintain the loan. The lender may reserve the right to call the loan at any time in whole or in part in accordance with the terms and conditions of the lending agreement. And the loan interest rates are not guaranteed beyond terms and conditions of the agreement. All right, so now let's move on to the collateral insurance deduction. So this could form a portion of an IFA strategy or be used as a concept in itself. So firstly, let's define the deduction. Paragraph 21E.2 of the Income Tax Act allows for deduction of a portion of the lesser premiums payable and the net cost of pure insurance if a life insurance policy is a collateral security requirement for a loan from a restricted financial institution. So let's look into this a little bit deeper. So the Income Tax Act may allow for deduction when a taxpayer assigns a life insurance policy that he owns to a financial institution as a collateral security for a loan. However, certain conditions must be met in order for the taxpayer to benefit from the deduction. Firstly, the loan must come from a restricted financial institution. The expression restricted financial institution is defined in subsection 248(1) of the Income Tax Act and includes a bank, a trust company, or an insurance company. Cannot come from a source that is not in the business of lending money, like a relative or a friend. The financial institution must require, as a condition for granting the loan, the collateral assignment to it of a life insurance policy owned by the borrower. The owner of the policy must assign the life insurance policy to the lender as security for the loan. The assignment will not be treated as a disposition of the policy, so no tax consequences will arise from the assignment itself. After the assignment, the owner of the policy may deduct the lesser of the premiums payable by the taxpayer under the policy in respect of the year and the net cost of pure insurance. Generally, the lesser of these two amounts will be the net cost of pure insurance when the insured under the policy is younger. As the insured ages, the lesser of these two amounts will eventually become the premium payable, which means that the whole premium payable may potentially be deductible by the owner of the policy. The CRA has adopted the position that the portion that can be reasonably be considered to relate to the amount owing from time to time during the year by the taxpayer means that the deductible amount of either the premium or NCPI is prorated, calculated with reference to the death benefit payable under the insurance policy and the outstanding amount of the loan without reference to other collateral or the cash surrender value of the policy. So to give an example of the portion of premiums that would be reasonably considered to relate to an amount owing, if we have a $500,000 loan and a $1 million life insurance policy, we can see that about 50% of the death benefit would cover the loan. This ratio is applied to the lesser of NCPI and the premiums to give us the collateral insurance deduction. So in that example, since we only require 50% of the policy, we're able to deduct 50% of the lesser of premiums and NCPI. So what is PAR additional deposit option? Now that we have a better understanding of the collateral insurance deduction, we can take a look at some of the product features that may reduce or enhance the deduction. As many of you are aware, Empire Life recently introduced the additional deposit option feature to our PAR plans. The additional deposit option is a feature used to enhance the value and flexibility of a participating life insurance policy. Over and above the base premium, clients can elect to make tax-exempt additional deposits to their policies that will be used to purchase paid-up additions. Paid-up additions purchased from additional deposits are added to the paid-up additions purchased from policy dividends and will almost immediately increase both policy cash values and death benefit values. With the immediate increase in total cash value and total death benefit, certain financial strategies will perform better using the additional deposit option. The early cash values allows the greater premium flexibility and the potential for premium offset, which gives us some of the benefits associated with limited pay PAR plans without losing the benefits of life pay plans. As mentioned previously, certain financial strategies, in particular leveraging strategies, may allow for a collateral insurance deduction when the life insurance policy is a requirement for a collateral loan. This deduction is maximized with the life pay participating plan. This deduction is of particular importance to those clients in higher tax brackets, as the higher the tax rate, the greater the deduction, and the higher the internal rate of return of any leveraging strategy will be. So if the potential for tax deductions are an important consideration over the lifetime of your clients, you may prefer to use Empire Life's Life Pay PAR with maximum ADO. And a quick disclaimer before we get into some numbers in a case study. The values shown are for illustrative purposes only and are dependent on annual dividends, which are not guaranteed. Values shown assume dividends are declared each year using Empire Life's current dividend scale. All right, so now let's get into a case study. Here we have Jack. He's a 45-year-old business owner, and he requires some financial planning. He requires some permanent life insurance coverage for his business loans and to provide for estate planning needs. He also has about $1 million in cash and fixed income assets that he can deploy. He wants to pay for his coverage quickly since business has been very good up until now, and it's still growing, but he doesn't know what the future may bring. With a growing business, Jack will likely require a loan to finance the expansion at some point in the future. So here we have option number one. Jack can purchase the Optimax Wealth Participating Plan with life pay payment duration, maximum additional deposits, and the paid up additions dividend option, and an offset in year 11. Using his existing cash pool, Jack is comfortable with a $100,000 annual premium. 10 years down the road, Jack wants to borrow funds so he can use the cash to put back into his business to finance its growth. The bank asks for life insurance to cover the line of credit in addition to other collateral and suggests he purchase their creditor life insurance. Jack already owns adequate amount of life insurance coverage and wonders if he can simply use his in-force policy to satisfy the bank's need for life insurance coverage on the line of credit. Since this is a life pay and we have premiums payable beyond year 10, even though the policy is an offset and the premiums are paid with dividends, the premiums are still payable and do qualify for the collateral insurance deduction. Here we have the second option, our Optimax Wealth 10-pay product with the paid up additions dividend option. This one is a guaranteed contractual 10-pay, so no offsets are being used. Remember, at the beginning of year 11, Jack wants to take out a loan so he can reinvest into his business to finance its growth. As opposed to the life pay with max ADO, you'll see a limitation with the deductibility of any portion of the life insurance premium. However, as you'll see, the benefit of getting the money into the policy earlier does increase the estate values. It would be very prudent to find out where the client's focus and priorities are upfront, as this will affect which product option may work best. In comparing the two options, we can see the guaranteed 10-pay will buy more coverage. The total cash value in year 5 and 10, or age 15 to 55, is better with the life pay and maximum additional deposit option. As well, you can see the total cash value in year 10 or age 55 exceeds the total premiums paid for the policy with the life pay. These cash values not only improve premium flexibility, but also the collateral insurance deduction associated with certain concepts, such as an IFA. As you can see, with the life pay and maximum additional deposit option, the collateral insurance deduction will continue for the life of the policy. So now here we have a tax summary. And starting off at the top, we see Jack's corporate tax rate of 50%. First, on the guaranteed 10 pay, I want to bring your attention to the first, third, and last columns. These columns all have to do with the collateral insurance deduction and the associated tax savings. When a life insurance policy is a requirement for a loan, the client can deduct the lesser premiums and CPI. As we can see, these columns, the highlighted columns, become zero after year 10. The collateral insurance deduction is based on the loan to death benefit ratio in addition to the premiums paid or payable. A guaranteed limited pay plan has no premium commitment beyond the limited pay period, in this case 10 years. I also want to point out at this time, you can see in the fourth column or loan balance column, the loan is increasing in this example, and we'll do another example with the loan remaining constant. Now consider the life pay version with additional deposit option offering a premium offset and reducing payments to the same 10 years. Since premiums are still payable at an offset, the deductions continue to grow after year 10. So you can see in the first column, the base premium, that is the premium without ADO, is $48,000 and is still payable beyond 10 years, even though policy dividends are being used to pay for the premium. Now we can see here if the client is looking for long-term tax deductions and tax efficiency, then the life pay payment duration with maximum additional deposit option and offset in year 11 may be the way to go. If it was an older client or a client who may be looking to retire or sell their business, the long-term deductions may not be as meaningful. In our case, Jack is 45 with a growing business. He prefers the long-term deductions. Jack is also in a higher tax bracket, which improves the tax savings numbers that are shown here in the last column. The higher the tax rate, the greater the tax savings, and the greater the performance of this strategy. Further comparing the two options, we can see the cumulative tax savings from the collateral insurance deduction in year 25 is significantly larger than that of the 10 pay. This is close to $100,000 in tax savings during the lifetime of the client that may not have been that they may not have had with a different product selection. We come up with this number by adding up all the annual tax savings from the last column in the previous chart. Remember, aside from the lesser premium / NCPI figures, these numbers are a result of the loan to death benefit ratio adjustment and a 50% corporate tax rate. Now, let's look at a different comparison here. We can assume that instead of allocating $100,000 per year into a life insurance contract, Jack instead purchased a $1 million life insurance policy up front. And comparing the two options, we can see the guaranteed 10 pay will require less premium than the life pay with maximum additional deposit option payable for 10 years. The guaranteed 10 pay in this case does not have ADO on it. And again, the life pay with the maximum additional deposit option will provide higher early cash values. And as with the last scenario, the 10 pay will have 10 years of potential collateral insurance deductions, while the life pay can have the deduction available for life. And here we have the tax summary again. With the guaranteed 10 pay, we can see the first column and the premium requirement beyond year 10 is 0, and therefore the lesser of NCPI and the premium beyond year 10 is going to be 0. Starting in year 11, this gives Jack 0 in tax savings associated with the collateral insurance deduction. Now, in this example, the loan balance remains the same throughout. And now with a life pay, we can see the first column, the minimum premium, that is the premium minus the additional deposit option, is still payable beyond year 10, even though the client may not be paying it directly out of their pocket as it is an offset. This now gives an opportunity for the lesser premium / NCPI to be greater than 0, and in fact may even be equal to the entire premium in some cases. The tax savings shown in the last column are once again shown to be increasing. And comparing the two options, we can see the cumulative tax savings from the collateral insurance deduction in year 25 is significantly larger than that of the 10 pay. Over $40,000 in tax savings during the lifetime of the client that they may not have had with a different product selection. The tax savings are lower than the previous example, simply because it is a smaller life insurance policy with a lesser premium requirement. Again, the numbers are a result of a 50% corporate tax rate, lesser premium / NCPI, and the loan to death benefit ratio adjustment. To summarize, the two product options, the new additional deposit option on a life pay payment duration can greatly enhance many leveraging strategies, including immediate financing arrangements. The guaranteed 8 or 10 pay payment structure does certainly have its benefits as well. When matching premiums, the Optimax Wealth Template will provide better long-term estate values and internal rate of return. The negative would be the lesser NCPI deduction after the payment period ends. The LifePay with maximum additional deposit option provides higher collateral insurance deduction in the long term, and as a result, higher tax savings during Jack's lifetime. This appeals to Jack's age group and business stage.